Welcome to the Black Wealth Creator Podcast, where we help uplift the Black community through financial education. Yo, welcome back to the podcast. I'm just excited, thrilled that you're here today to learn more about finance and just learn more about educating yourself, making yourself better for you as well as for your family. So on this podcast, of course, we're talking about building wealth and helping Black people gain wealth and just become wealthier overall. So one of the biggest things we can do to build wealth and uplift and increase our wealth is to retain our income. Like, our income is going to be our biggest wealth building tool. So that means we have to get the most bang for our buck when it comes to income. And the best way to do that is to eliminate debts or minimize debts to as low as possible, that you can, like I said, get the most bang for your buck for your income. Because if you're only making like $40,000 a year, in 10 years, that's $400,000. Okay. So it's like, whoa, like when you really start to think about the amount of money you actually make over time. And I know that's not like $40,000 isn't a lot, but it's a lot to some people. And so, like I said, in 10 years, you've made $400,000. But if you have debts that are around $39,000 or $39,500 a year, then in at the end of those 10 years, you're left with $5,000 in savings. You know, if you were to save the amount that you're bringing in. So it just lets you know, like, really, if you can get out of debt, the sooner you can get out of debt and the quicker you can get out of debt is best for you. But I'm not gonna teach a debt-free. I feel like that's your decision to make. Like, and so you might hear this term about being debt-free, or you might hear terms about debt, and you think like, what is debt? And it's no, like, listen to me, like, I'm not like poking fun at you or anything, because a lot of times we just don't have education about things. And that's the whole point of this podcast. So I'm trying to break it down to the bare minimum. Like, you're like, oh, we got to be debt free. It's got to be debt free. Like, I hear that term all the time, but what is debt? Like realistically, like, what is debt? So in the Black community, we might say just bills. And so you automatically think like, oh, okay, all bills are debt. And it's like, no, that's not true. Like, not all bills are debt. Some bills are just expenses that you have every single month. No matter if you're debt free or not debt free, you're going to have to pay your light bill. So those are expenses that come every month. That wouldn't be considered debt. That's just living expenses. I want to break down on this lesson, what is debt exactly? Debt. There are 4 types of debt. There is, and I got my notepad here. Like I told you, I'm doing research. Like I'm out really trying to learn myself as well as teach you. So there are 4 types of debt. There's secured debt, unsecured debt, revolving debt, and mortgage. Secured debt. Secured debt is collateral-based debt. So that's going to be your car payments, or your car loan if you get a car loan. That's going to be that type of debt. A boat or some big equipment you might have that you're going to finance, 3 to 5 years. They actually have like 7-year auto loans now. So it's however long it takes, like however long that thing is, that's going to be a secured collateral debt. And one of the main things that they do, they're going to verify your credit worthiness. And that means they're going to check your credit. And so they're going to validate, like, in terms of secured debt, in order to get it, or in order to secure it, they're going to validate that your income, which is a part of your credit worthiness, like, can you actually pay for what you're saying? And then, do you routinely pay for the things that you get in terms of your old car payments or your old what are the other debts you might have? Like, do you actually pay for what you do? And then also, they're going to give you the value of the item. Like, there's a valued item. So if I'm giving you a $20,000 car, they're gonna validate that car is actually worth $20,000. and they're going to validate if you're able to pay it. So those are going to be the two validating points when it comes to secured debt. Unsecured debt. And unsecured debt is that's where you're going to get credit based, and they're strictly looking at your credit report, strictly looking at, okay, can you and with credit, they're not really caring about can you afford it, because it's like a credit card or a student loan, those types of things. It's unsecured, so it doesn't have that backing of a collateral thing that they can come take from you. So with your unsecured debt, like I said, it's going to be your credit card payments. They're going to really just be checking like, okay, does he have any outstanding balances, and can that person afford credit? Like, can that person actually that's when they set your limit. So your limits, they're not going to give you a $50,000 limit and you only make $10,000 a year. I know it's kind of low. Let's go $20,000 a year, and you get they're not gonna give you a $50,000 credit limit. They're gonna make your limit. They're gonna try, normally. But if you get up, they don't care, because they're gonna be charging you interest every month. So that's how they make their money. Revolving debt, and revolving debt is a line of credit on an amount that the borrower can continuously borrow from. So basically, revolving debt is that line of credit. So the credit card itself, remember I was saying, like, all of these things kind of tie into each other. So unsecured debt would be like a credit card. The credit card itself could be considered as revolving debt, because each month, whatever your limit is, you can spend that limit each month. And if you pay it off, they don't, they're happy you paid it off, but they would rather you revolve it, of course. But if you pay it off, the $500 limit, if you pay that off, then the next month you still have $500. Like, it's a revolving amount that you can have. Or you may have heard of line of business with like a bank or something. Or I'm sorry, line of credit. Apologies. Like a line of credit with the bank or something. And with that, they might give you, okay, you got $2,000, especially if you got like a small business or something, and you need equipment. They're like, okay, you got $2,000 whenever you need, write a check, write whatever you need to do to that line of credit, pay for whatever you need to pay for, and then, pay us back. If you don't pay us back in full, then we charge you interest on what you have outstanding. Mortgage, and we all know about mortgage. We all know what a mortgage is. Whether you bought a house or tried to buy a house or looked into buying a house or heard stories about buying a house, we all know what a mortgage is. And so a mortgage is just, and of course that's collateral based, which would mean it would be a secured loan, but because it's so unique in nature in terms of the amount of scrutiny that they put you through in terms of your credit worthiness and your ability to pay for a mortgage, that's why it has its own separate category when it comes to debt. And so getting into mortgage, the reason, like, sometimes people like, man, why they so strict about what mortgages they get out, and why they so there is a racial undertone. We know that, like, we're not blind to that. We know that it's getting better, but we do know historically, looking back, that Black people weren't given as much opportunities to purchase homes. I've read books like about this, like they charge a Black person 3 times as much for a house, and then even when they get the house, it drops in value, because a lot of times that neighborhood, just off of how they would start appraising the value of homes in that area, it would immediately drop like half value. So you're paying 3 times as much for a home that is not even worth the amount that you initially paid 3 times as much. So we're talking about you're paying 6 times as much, because if it was a whole, you bought it 3 times as much, and then you divide what it's actually worth by half. Like, that's 6 times as much you're paying for a home, and it's not even worth it. So it's just a sad reality of the convoluted relationship between Black people and home ownership. And it's a sad reality, but it did happen and it did occur. So it is what it is. But like I said, mortgage is something I know me growing up was just it. Like when someone bought a house, like, oh my God, congratulations, but that is debt. Like that is debt. It's a huge debt depending on what kind of home you got and what kind of mortgage you have and all that type of thing. So it's just another form of debt that there is out there, mortgage. But going back to my final point on mortgage is the scrutiny behind like why they put you through so much scrutiny. Like I said, there is a racial undertone there, but even more so, there's a monetary, like I'm giving you $200,000. I'm giving you $200,000 to purchase this home. Like I gotta know that you're gonna be able to pay me back. I gotta know this. Now let's not be crazy, or let's not realize that they're probably gonna make, I don't know, close to $400,000 off of you, the life of the loan. So of course you're gonna get well compensated for it. But you can understand why they may be so like, I gotta make sure that whether white, black, or whatever, I can understand why they scrutinize the process so much. It's just historically we've seen that black people have gotten the worst end of that stick a lot more often than their non-black counterparts. So we've discussed debt. 4 types of debt. Secured, like I said, that's your car, your thing that has some type of home, that has some type of collateral. Unsecured debt, that's going to be like your credit cards. It's going to be really based off your credit worthiness in terms of how much of a limit you have. Then you get revolving debt, which is a limit is set, and each month, as long as you pay it, you can have that. And then lastly is mortgage, where it's a very large purchase, is heavily scrutinized, and that's a mortgage, So lastly, I wanted to play a quick game, and I want you to guess whether this is a debt or utility. And a utility is what I was talking about earlier, where it's like an expense that's going to happen every month, no matter if you're debt free or not debt free, or you're drowning in debt or whatever. No matter what, each month you're going to have this utility. So it's either a debt or a utility. So first, groceries. Do you think that's a debt or a utility? Utility. All right. So next, car note. That's what we know. We call it car note. It's a car payment. Is that a debt or a utility? Debt. Yeah, that's a debt, because the car is a secured loan, and it's also you're paying towards it, and you're going to eventually pay it off one day, and you won't have that debt anymore. So that is a debt. The light bill. Utility. Yep. That's a utility, because no matter what, you got to pay your light bill. You can cut down on your costs, like turn off the lights when you're not using all that stuff. You can cut down, find ways, more efficient light source and all that stuff. But at the end of the month and at the end of the day, you're going to have to pay that light bill no matter what. You can get it lower, but you still got to pay it each. Gas. Utility. Yep. If you go somewhere, you're going to have to pay that gas bill. Or if you live in a gas home, you're going to have to pay that gas bill for heating and stuff like that. Credit card payment. Oh, I might have gave it away with that. Is it a debt or a utility? Debt. Yeah. We talked about credit cards directly. So credit card payment, definitely debt. Student loan. Debt. Yep. Water bill. Debt or utility. Yep. No matter what, you're gonna have to pay that water bill. Mortgage. Debt. Absolutely. Yep. Debt, because you're paying it off. If you're paying it off, if it's a large sum that you pay off and you don't have to pay on it anymore, that's a debt. Whether you got a credit balance or got $1,000 credit balance, you pay it off. I don't have to pay it anymore. I don't have a light bill balance. Like I might have to pay off what I need to pay for that month, but come next month, they're going to put another $120 on that. So yeah. And then lastly, shopping. Is that a debt or is that a utility? It's a utility. Now if you use your credit card to shop and then you have to pay for the credit card, then yes, that's a debt. But if you're just talking about a shopping budget item that you have, then yeah, that's just a utility. Kind of threw that in there to foreshadow like when we talk about budget. So yes, a shopping item that we have in our budget, it would come every, if we're going to do it every month, it would be considered like a utility in that instant. Once again, I just want to do this lesson about debt because we hear about it all the time, and I just wanted you guys to be more knowledgeable about what debt is and what debt isn't. Thank you for listening today. Remember, getting money is easy, but building wealth takes time and effort. Anybody can do it, especially you. Be blessed.